What are your views on where private equity are at in their fundraising and deployment cycles?
Most private equity funds work on a 5-year deployment, 5-year realisation cycle. So what they look to do is raise funds and they deploy them over a period of 5 years. After each investment, they'll look to realise it, hopefully after 5 years, and then effectively they'll spend 5 years collecting in, and then they will go and raise their next fund every 5 years. So at the moment, a lot of funds have aligned their cycles because of coronavirus. So when coronavirus hit in 2020, a lot of funds recycled into a new fund effectively. That means that for the first time in a long time, private equity has become unusually aligned. That means in 2025, a lot of funds have been out trying to raise at the same time. What that's meant is that they've not been able to raise quite as much money or any money at all. That means they've raised smaller funds, or they might only be raising on a deal-by-deal basis going forward. That does mean, however, that those funds that have been successful raising will be looking to deploy finance going forward. It does mean for 2025 there's been less private equity activity, and that's borne out if you look at the stats. There have been more trade sale transactions than there have private equity transactions in the current year.
What are the impacts on that for UK SME businesses looking to either sell or raise investment?
Most businesses don't make financial decisions about sale based on what's going on in the private equity market or what's going on with the budget or so on and so forth. They tend to make decisions based on personal circumstances, so whether they've got old or they've got ill or they've fallen out with somebody or something's happened within their life that means that they've made a decision to move on. So it tends to be fortuitous whether you will go into the market in a good or bad time. Generally what that does mean though is that if businesses go into the market at a time that doesn't suit the market, then they might not have the outcome that they're looking to. So it is imperative that they speak to an advisor to find out whether it is an optimal time and do what they can to prepare. In the current cycle, what that does mean is that private equity have currently been spending 2025 fundraising. So in 2026, they will have more funds to deploy. That means if you are looking at a sale to private equity, now is a good time to prepare, because if you go to market in 2026, there will be quite a lot of funding available. That does mean that you've now got a period of time to prepare your business for sale. So if you are thinking about selling, it's a good time to reach out to an advisor to start looking at how you might be able to prepare that business for sale. The earlier you start that process, the more you'll be able to drive value in that process.
How long are deals taking to go through?
So transactions can vary depending on how prepared you are. Now, a typical transaction, particularly for a sale, will typically take 6 to 12 months to go through at the moment. A lot of that is driven by lack of information available from the business. So if you prepare earlier and do some business readiness, then you might be able to get a transaction to go through in 3 to 6 months. Some of the things that you can do is work with an advisor with a track record for getting things done quicker, or potentially getting somebody who specialises in business readiness to come on board. So one of our sister companies, K3 Advantage, does business readiness, where they will come in and help you prepare board packs effectively that will be able to help accelerate that process. So starting the process earlier means that your information's in a better place, which means that when you do go, you'll be able to do that transaction quicker.
Will that change in 2026?
2025 has been a year where we've seen more trade activity than PE activity. That's largely been driven by the private equity funds raising and realisation cycles. Because those private equity funds have now raised funds and are looking to deploy, we will start to see an increase in private equity transactions in 2026. That means that there are going to be opportunities for businesses that have got strong growth prospects to find good buyers, and in particular next year we'll see an increase in the supply of funding in that particular space. With the change in the current macroeconomic environment, businesses that will do particularly well include businesses that have any form of technology or AI in them. That seems to be an area that investors are looking at strongly at the moment. If you are in one of the more traditional types of industries, then you might need to sort of speak to an advisor about where the opportunities are for investment in your industry.
What sort of businesses will benefit from the current conditions?
The market tends to follow trends. At the moment, there is a huge interest around artificial intelligence. There are good and bad things about artificial intelligence. In particular, it will change the way that the world works. However, because people are so interested in it, there's almost an overexcitement of interest and almost what people might call a bubble. That does mean that if you have a business that has artificial intelligence or technology characteristics, then you will effectively be able to potentially leverage that and sell your business at a premium. It does also mean that there is a timing issue as to when you do go and whether or not you get maximal value. Other businesses that might struggle more traditional areas such as manufacturing and automotive businesses. Those businesses may find it harder to attract financing while there is a buzz going on about artificial intelligence. However, there are funders that specialise in supporting those industries, and to access them you should speak to an advisor that knows what they're talking about in that space.